Welcome to Speidel's Federal Tax Minute. I'm your host, Catherine Zidane. This week, we're covering the new IRS form for making an IRC Section 83B election and the basics of Section 83. Sign up for Speidel's quarterly federal tax update webinar, and you'll get reliable and pertinent updates on trending tax topics. Register for the 2025 quarterly federal tax update by the end of the day on December 31st, 2024, and save 20% using discount code QFTU20. You can get more information at speidel.com under webinars. The IRS has created new Form 15620 Section 83B election, which is an approved form for making an IRC Section 83B election. Previously, taxpayers prepared their own election in whatever format they chose, as long as the election contained all the required information. The IRS issued a sample election statement in Revenue Procedure 2012-29 that taxpayers could use, but that sample election statement is no longer necessary. The instructions to new Form 15620 do not appear to require its use, but it's not advisable to file an election without using the form the IRS has specifically created for this purpose. IRC Section 83 governs the tax rules for property transferred in connection with the performance of services. In its simplest form, Section 83A provides that if a taxpayer receives something of value in exchange for their services other than cash or cash equivalent, then the taxpayer is required to recognize ordinary income equal to the fair market value of the property received. For example, if an employer pays an employee one share of stock valued at $1,000 instead of paying the employee $1,000 cash, then the employee will recognize $1,000 of ordinary income, which is reportable on the employee's W-2. Getting a little more technical, under the rules of Section 83A, a taxpayer does not recognize income when property is received unless the property has a readily ascertainable fair market value when granted, and the property is not subject to a substantial risk of forfeiture. The rules of Section 83A and its related election under Section 83B are most typically used by employees who receive stock options, but it can apply to any property received in exchange for services. Using non-qualified stock options to illustrate Section 83A, employees do not have a taxable event when the stock options are granted. This is because after the grant date, there is a vesting period before the employee can exercise their options or purchase their company stock. Until the vesting conditions are met and the employee actively exercises their options to purchase their company stock, the property has a substantial risk of forfeiture and is therefore not yet taxable. Incentive stock options contain additional beneficial rules that allow the employee to delay income recognition until the stock is eventually disposed of, which is even later than the exercise date. Section 83B allows taxpayers to elect to include the value of the stock at the grant date, less any amounts paid by the employee. The goal of the election is for the employee to recognize ordinary income when the stock has a very low value, and then only recognize capital gain later when the stock has a much higher value. We cover the Section 83B election in greater detail in the January 2025 issue of Speidel's Federal Tax Letter, including the risks of making the election and timing issues. For details on this monthly publication, go to speidel.com and click Publications. That's all for this week. Join us next time for another episode of Speidel's Federal Tax Minute.